Good day everyone, how are you? Welcome to the Value Machine channel. Today we're going to talk about something that you probably heard so many times over this weekend and over this week, and that's the inverted yield curve. But before talking about it and explain it, first we have to understand what bonds are. Important things that you should know about bonds. First, it carries an interest. Interest or coupon is the amount of money that the government will give you or pay you throughout the lending period. Okay, every 6 months, every 1 year, it depends. And there's also something that's called face value. That means when the lending period is over, the government will give you the money or the face value that the bond was issued on. So let's say that the face value is $1,000 and the price that changes with the demand, let's say, became 1,200. At the end of the period, they will pay you 1,000 because that was the face value. And we have something also that's called yield. And of course, the price of the bond. And there's also something that's called maturity. The maturity is when the lending period is over and the government will pay you the face value. An important dynamic that we should understand before continuing is how the prices, the coupons, and the yields are all connected. So if we're talking about a coupon, let's say we're talking about interest that is $100, okay, and the price of the bond is $1,000, the yield would be coupon, and that's the price, right? The yield will be how much? 10%. So let's imagine something like this. A lot of demand is pushing the price higher, and the interest will still be 100. And the price would be 1,100. The yield will become approximately 9%. We can understand from that every time the price goes higher, the yield goes lower, right? And that's how you probably heard that a lot, that the prices of the bonds and the yields move inversely. And now you understand why. Now let's dig into the yield curve and let's talk about bonds, and especially the government bonds. Okay? So there are 3 types of government bonds. We can divide them by their maturity. So we have bills, which goes from 1 month to 1 year. We have notes that goes from 2 years to 10. And we have bonds that are 30 years. Now I want to ask you a question and I want you to answer it with logic. If you're going to lend money to someone, let's say you're going to lend them money for 3 months, okay? You lend them money for 10 years, and you're lending the same person, we're talking about the same person, and you're lending that person money for 30 years. And I will ask you a question. If you're going to lend the same person money for those periods of time, and I give you a scale from 1 to 5%, which will be the yield, how much money you will make on your money that you lend, the yield that you will ask on the 3 months, I assume would be lower than the yield you will ask on the 10 years, and the yield you will be asking on the 10 years will be lower than the yield you will be asking on the 30 years. You're locking up your money for a longer period of time. Let's say you will demand for the 3 months 2% yield, for the 10 years you will demand 3%, and for the 30 years you will demand 4%. If you want to translate those numbers into a chart, the y-axis would be the yield, the x-axis would be the time. By time, we mean holding the bond during this time. The 30 years, which have a 4% yield, would be over here, right? And assuming that there's no rate hikes or no rate decreases, it would look something like this, okay? That would be the 30 years. the 10 years would be over here. That would be the 10 years. And 3 months would be over here with the 2%, right? That's 2%, that's 3%, and that's 4%. That's how the yields will be. And the gap between the bonds is called spread. That's the normal case, and that's how it should be. So if we want to talk about curves and yield curves, let's take this table out and translate this chart into this chart that I'm going to draw right here. The chart would look like this. The x-axis would be the maturity of the bond. Maturity of the bond. Here it would be the 3 months, 10 years, and 30 years. And here it will be the yield. So the yield here is 2%, right? On the 10 it's 3%, and on the 30 is 4%. We can see that the curve is an upward slope. And that's the normal case, that's how it should look. So right now let's talk about what happened on Friday and what's been happening for this week. We're still talking about 3 months bills, 10 years note, and 30 years bond. Okay? And if I'm going to draw here the 30 years bond, it would be going down. The 10 years would be doing the same thing. Okay, and over time the 3 months bond was doing also the same thing until it started going higher, and that's because the Federal Reserve started raising rates. But you should know that the yields were going lower since 2008-2009. Okay, here is when the Fed started raising rates, and the 2% yield started going higher. But also the 3%, by the way, started going higher because the economy was expanding and people weren't interested in buying bonds, they were interested in buying stocks, because if the economy does well, also stocks do well. So at some period of time, the yield on the 10 years was also going higher. People started getting worried about the economy, and when people started getting worried about the economy, they started buying bonds. Remember when we said that if the price goes higher, what happens to the yield? Right, it goes lower. And that's what happened over here. The yield of the 10 years started going lower, eventually to the point that the 3 months yield became higher than the 10 years yield. If we want to translate those numbers into this chart, the same one that has the maturity on it, here it would be, let's say, 2.5%, here it would be 3%, and here it would be 4%. The 3 months yield would be over here. The 10-month yield, which is lower than the 3 months, would be over here. And the 30 years, which is still higher than both of them, would be over here. Okay, and if we want to make right now a curve, it would look something like that. And that's what inverted yield curve is. And since 1975, each time this thing happened, it was followed by a recession. That's why the market plunged on Friday. So this indicator doesn't predict when the recession will happen. So we don't know exactly if it will happen in 1 year, 2 years, 3 years, maybe in 2 months. So what you should focus on is good businesses and invest in them. And I hope you like this video and I hope you understand it. For any question, for any comment, please comment below. Subscribe to my channel and hope you like this video. Have a great day.